Okay, so why do 80% of investors consistently lose money? I mean, that is a staggering statistic, right? And these aren't necessarily people lacking intelligence or work ethic, yet cycle after cycle, the vast majority of people manage to do the exact opposite of what they should. They buy high and they sell low. Why do we constantly self-sabotage our own wealth like this?
Honestly, the answer really just boils down to two primal words: greed and fear. We love to think of the stock market as this super complex math problem, but it's actually a massive psychology test. And it's a test most people fail every single time.
Welcome to The Explainer. Today, we're extracting what is absolutely one of the most powerful insights from our source material on investor psychology, a completely predictable psychological roadmap that governs every major market reversal. Once you really understand this cycle, it completely removes the surprise from market crashes and gives you an incredible edge.
All right, let's just dive right into this four-stage journey. We'll be looking at stage 1, the euphoric peak; stage 2, the snowball effect; stage 3, the absolute bottom; and finally, stage 4, cautious recovery. Starting things off with stage 1, the euphoric peak, maximum greed at the top. Picture this. The bull market has been running for years. Everybody's making money. And the prevailing belief is, hey, stocks only go up. And honestly, you don't need a finance degree to spot the signals here. Record IPOs are massively oversubscribed. Celebrity-endorsed investment apps are completely dominating your social feeds. Even your Uber driver or your dentist is suddenly giving you hot stock tips. Literally, everyone feels like a financial genius. But listen, make absolutely no mistake, this is actually the most dangerous time to invest. Because right beneath the surface, there's this terrifying disconnect happening. On one side, you have everyday retail investors day trading on their lunch breaks, fully invested and totally optimistic. But on the flip side, the smart money, the institutional investors, the hedge funds, they're quietly reducing their exposure. The music is definitely still playing, but the pros are already inching toward the exits. And underneath all that relentlessly positive media coverage, the math is telling a very different story. Market valuations are hitting historic extremes. We're talking price-to-earnings ratios at multi-decade highs. The market is literally priced for absolute perfection, which means the whole illusion is incredibly fragile. One tiny piece of bad news is all it takes to shatter it. Which brings us right to stage 2, the snowball effect, where the panic selling begins. So that illusion shatters, usually triggered by one single catalyst. Maybe it's a surprise interest rate hike or a sudden geopolitical crisis. And it starts with an initial 5 to 10% drop, but then it accelerates. Investors who borrowed money to buy stocks, those with leveraged positions, suddenly start getting margin calls. They're forced to sell just to cover their debts. And this forced selling, it adds massive downward pressure, which triggers even more margin calls and more selling. The snowball is rolling downhill now, getting bigger and faster, turning what looked like a minor dip into a brutal 30 to 40% crash. But how does the average investor actually react during that very first drop? Usually, they just say, it's just a healthy correction. They shrug it off, they hold onto their falling assets, or even worse, they mistakenly buy more, totally convinced they're getting this great discount before that snowball really accelerates and wipes out their capital. So the absolutely crucial point here is the stark contrast in outcomes. The unprepared investor is facing extreme wealth destruction right now, just completely trapped by panic and margin calls. But the prepared investor, the one who actually read those real-world euphoria signals in stage 1 and smartly held onto their cash, they aren't panicking at all. They are calmly pulling out their shopping list. And that shopping list gets deployed right here in stage 3, the absolute bottom, stopping fire with fire. This is, without a doubt, the darkest, most terrifying phase of the whole cycle. Capitulation happens as the very last holdouts just throw their hands up and sell everything on massive volume. And we don't even have to guess when people are terrified. We have actual mathematical proof. The VIX, which is also known as the fear gauge, spikes above 40 during this capitulation phase. When the VIX is above 40, market optimism has plummeted below 15%. That number tells you panic is absolute. So how do you actually know when we're here? We'll use this practical checklist. You see the VIX above 40. You see extremely high volume selling. The mainstream media is running these apocalyptic headlines using words like depression or total collapse. 80 to 90% of all stocks are hitting 52-week lows. And perhaps the most telling signal of all, public investing discussions go completely silent. Nobody at the dinner table wants to talk about their stock portfolio anymore. When you see this list checked off, remember this.
maximum danger is actually maximum opportunity. These are your buy signals.
Because it's exactly at this point of maximum panic that something crucial happens. Governments and central banks are basically forced to step in to stop the fire. They deploy interest rate cuts. They launch massive emergency stimulus packages and direct market support programs. This right here is the ultimate turning point that begins stabilizing the entire financial system.
And that massive government intervention paves the way for stage 4, cautious recovery, the light at the end of the tunnel. Now, keep in mind that stimulus takes months to actually show up on Main Street, but the stock market, it's always looking 6 to 12 months ahead. But think about our retail investor, the one who just lost everything. They watch the market start to take back up, and they just say, oh, it's just a dead cat bounce. They simply do not believe the recovery is real. They sit on the sidelines waiting for certainty. But here is the brutal truth. The stock market doesn't wait for certainty. By the time the general public feels safe again, the market has usually already surged 30 to 50% from the absolute bottom. If you know what to look for, the early recovery has some very distinct signs. You'll see cautiously positive news start to peek through. Corporate earnings stop free-falling and finally stabilize. Unemployment stops rising. And you'll always notice that the highest quality, most fundamentally sound companies out there, they are the very first ones to recover and break out. And you can trust this roadmap because this exact 4-stage cycle has repeated throughout history, every single time. 1929, 1973, 1987, 2008, 2020. Now sure, the causes are always different and the depths of the crashes vary, but those 4 stages, they are identical. And every single time, without fail, the recovery came. Which brings us to the absolute most important takeaway from this entire explainer. The next cycle is already in motion. The next peak, the next crash, and the next recovery, they are inevitable. But you now have the roadmap to read the emotions of the crowd and act against your own natural impulses. So the question isn't if the next recovery is coming. The real question is, when it arrives, will you be positioned for it?